Hi, everyone. Welcome, welcome, welcome. We are so excited to have Jason Debono here from New View, Self-Directed IRA company. And he has about 17 years. He's an expert on everything you could possibly think of doing inside of a self-directed IRA. So if you don't know what a self-directed IRA is, Jason is going to tell you. We know a lot of you do have self-directed IRAs, and we know some of you don't. And there's so many different ways that different companies run their IRAs. So please ask the questions because every company is a little bit different. And what you want to know when you're hiring a company are the things that are important to you. Do you have your own person that's going to be supporting you, for instance, or do you have to talk to the person that answers the phone and tell them the same story 200 times before you can actually get your investment made, for instance, and other fun things like that. So here we go. Jason, take it away.
Well, thank you, Peggy, and hello, everybody. As Peggy mentioned, I'm with New View Trust Company, and my current role as president. I do a little bit of everything, but I'm going into my over 18 years now, almost 19 years of being in this space, and certainly a lot has changed over the years. But the core fundamentals of kind of self-directed and IRA really haven't changed much. And that's kind of the cool thing. But we've seen some market conditions, and we'll talk a little bit about that today. I've got about 15 minutes or so. I'm just going to highlight a couple of things, and then we're going to open the floor up to Q&A. So I look forward to kind of going in any direction that you guys would like to, and making sure that everything that you want covered gets covered. But without further ado, we'll kind of dig in. For those that don't kind of know the world of self-directing a retirement account, really what we do as a custodian is we allow you to invest beyond Wall Street investments. So if you think about most financial services companies like Charles Schwab or Fidelity or banks, they're really in the business of holding IRAs, and they're in the business of holding them in public equities. New View Trust Company is a state chartered trust company. We are regulated by the South Dakota Division of Banking. We have full trust powers, but the services that we offer are passive custodialship of retirement accounts. And in doing so, it allows you, the investor, the client, account holder, to invest into really anything. And our specialty is in assets outside of stocks and bonds. So, we kind of think of it like you need us when you want to buy an investment that Charles Schwab doesn't want to deal with. So if there's no ticker symbol, if it's not publicly registered or publicly traded, which is a world of investments out there, that's where we come in. As far as having an account with us, we do the same reporting and the same, sort of tax forms and tax reporting that Schwab does. So you're not getting a different type of account, but you are getting an account that just has really unlimited investment choices. And in the eyes of the IRS, as long as you invest passively, and as long as you invest at an arm's length, meaning you're not using your IRA money for your own personal benefit or that of your family members, then you pretty much have free reign to do what's best for your account. But New View's been around. We're celebrating our 20th year. We've got about $2.5 billion of assets that we custody, and everything that we custody, for the most part, is all some sort of private investment. So when we talk about, what is the self-directed account, it's really two parts. Number one, it's an account in which you, the account holder, choose each and every investment. And that's really a critical kind of thing to understand. I think that's where, working with Peggy and her team, they're here to kind of support and help you find investments and gain access to investments that really the general public may not ever come across on their own. And then the second thing is that in a self-directed account is that you can hold anything that's not personally beneficial to you, or anything that you're using for your own investment or that sort of thing. So when you think about self-direction, what you're really doing is saying, I believe that there's better choices from an investment standpoint beyond stocks and bonds. And if you believe that, then certainly the opportunity is there, and a custodian like New View can help you get there. Couple things that we had chatted about kind of covering today is, what does it take to get into a self-directed account? The first step is really moving funds from an existing account. Typically, that money is either an existing IRA, or it's an old employer's 401k or 403b, 457, some sort of governmental employer plan. So if you've got money sitting in a legacy 401k from a previous employer, you can roll all of that into a self-directed account. Or if you have existing IRA funds at any custodian, you can transfer those into a self-directed IRA. If you have your funds with a self-directed custodian and you're not happy with them, you can transfer those as well. So they're all portable, meaning you can take both cash or investments from company A and move them to company B. That's a pretty easy process as well. We won't spend a lot of time on that today, but I know there's been a handful of folks that have voiced some frustration maybe with some of their current custodians. And so if you think NewView can be a better solution for you, we can talk through that. But just know that your accounts are portable. You can move or elect to move them at any time. If you're currently employed with a company, chances are you're not going to be able to access that money while you're still employed. So we get that question a lot. Somebody's worked, like I've worked for NewView for, 18 years. I've got a 401k. I cannot just go roll that money out while I'm actively employed. So if you do have that, certainly chat with Peggy and her team or chat with our team, and we can kind of walk you through some of the opportunities to move it. But we want to set expectations. Really, the easiest portable and accessible money is going to be previous employer money or any sort of existing IRA account. As far as your investments, we chatted kind of a little bit or alluded to the fact that you can't use it for any personal gain. You can make as much money in these accounts as you want. There's no limits. Just make sure that you don't invest into anything that you're personally associated with or have any close family members that are personally associated with. There may be some gray area where there's some opportunity to do so, but as a general rule, if I was going to invest into a investment that my dad managed, a syndication, I may want to be careful. So pretty simple if you're investing into passive investments, which I know a lot of the individuals on the call are. Usually it's kind of a moot point, but we always like to make sure that people understand kind of where those boundaries are so that they don't go out and engage in something that the IRS may take issue with. The one thing that we really like to talk about inside self-directed IRAs that I don't think people give enough credit to IRAs for is their tax benefits. It's such a powerful tax tool. And it's really the only tax tool that's readily available to everyone with no complexities. There's a lot of great tax strategies out there, 1031 exchanges, qualified opportunity zones, and all these, tax deferrals and write-offs, and a good accountant can help you navigate those. But an IRA is really the only tool that has a built-in tax deferral or tax-free mechanism that's readily available to all of us and takes does not take any sort of scientific CPA forensic accounting to manage. So if you have an IRA and you're not maximizing your contributions, I can't encourage you enough to do so. Every dollar you don't put in an IRA is a dollar that can't grow tax-free for you or tax deferred. So, we're here to talk about the investment side, but I would be remiss to not at least mention the value of getting money into these accounts. The other thing that we like to talk about is that it's not a one-size-fits-all approach. And I think a lot of times, a lot of custodians are just here to service you, right? Tell me what you want to do and we'll help you do it. And we really take a little more educational, holistic approach to, do you have enough money in all of the accounts you're eligible for? So you can self-direct your IRA, you can self-direct a Roth IRA, you can self-direct a SEP, you can set up a solo 401k if you're self-employed and self-direct that as well. You can self-direct an HSA if you have high deductible health insurance, and you can self-direct an ESA, which is an educational savings account for your kids. So those are all tax deferred or tax-free accounts that fall under the IRA guidelines that give you built-in tax deferral or tax-free growth. And all of those accounts can be self-directed. And what's really cool is they can be self-directed alongside each other. So you can take 2 or 3 of the same account or 2 or 3 different accounts and buy the same asset. So for example, I have a 401k that I self-direct. I have an IRA, a Roth account that I self-direct. I have an HSA that I self-direct. And then I have 2 ESAs for each of my kids that we also self-direct. So I've got a total of 5 different accounts, and I can choose to invest them individually, right? I.e., I can put $25,000 into this deal or $50,000 into this deal out of any one account, But in some cases, depending on the offering, I can actually put in 50 grand or 25 grand, but I can take 5,000 for my son's ESA, 5,000 for my daughter's ESA, 10,000 for my HSA, and 5,000 for my Roth, and make that $25,000 investment. So there's some really cool strategies. If you're not looking at that, or you're kind of looking at these as pick one and set it and forget it, there may be some opportunities to add to it. But I want to highlight the tax benefits in very simplistic terms. If you were to take $1 and you were to double it for 20 years, right? So $1 grows to $2, $2 grows to $4, $4 grows to $8, and so on. And you did that in a taxable account at 25%, meaning $1 grows to $2. You pay 25% tax on the dollar. You've got 175, right? 175 grows to 350, but you pay tax at 25%. If you were to take the dollar and you were to put it into a taxable account and you doubled it every year, paying 25% tax on your profits, at the end of 20 years, you'd have $78,000. Now, most people would say that's a pretty good deal. You turned $1 into $78,000. And for most people, when they think that, they kind of think that's good. And they tell their friends and their buddies and say, hey, look at this. 20 years ago, I had $1 and today I've got 78 grand. What the wealthy do, and what the aspiring wealthy do, and what the people that take advantage of tax do, is realize that there's a better way to do the exact same thing and keep more of the money. So now let's compare that to, instead of doing that in your personal name and paying 25% tax, let's assume you took the dollar and put it into a Roth IRA. You paid tax on the dollar when you put it in, but every year for the next 20 years, your entire return is yours and can be reinvested in full. Now, keep in mind, it's the same time period, the same investment, the same return. So we've not done anything different, but simply said, I want it in a tax-deferred or tax-free vehicle from the beginning. That same dollar, instead of being $78,000, is $1,048,000. So I want everyone to really think about that from this standpoint. Same dollar, same investment, same time frame, but the difference is nearly $1 million. And so if you really want to understand why the wealthy stay really wealthy or get wealthy, and the working class individuals, unfortunately, stay working class, is because they never factor in how much taxes impact their return. And so when we talk about IRAs, yes, investments are fantastic. And I know Peggy and her team are certainly can give you some guidance and insight into all the things that you can do with the accounts. But what I really try to highlight is, if you just put more dollars in your IRAs, and you make good quality investments, you won't just have more money, you'll have exponentially more money. So next, as you get to the end of the year, as you get to April 15th and you're filing your taxes and you're going, well, maybe I'll only put 2 grand in my IRA because I'd rather keep the money, max them out. And remember, every dollar in a tax deferred account over 20 years, doubling every year, is almost $1 million more than leaving that money in your taxable account. So don't let the tax tail wag the dog, but don't underestimate how much taxes can actually impede or impact your ability to build wealth. Uncle Sam, does a lot of great things, and this presentation isn't about whether the dollars are spent wisely or not. That's an individual opinion. But I think we'd all agree, if there's perfectly permissible legal ways to keep more of our money and pay less in taxes, we should be utilizing them. And so this is not it's not a forensic accounting scheme that you've got to kind of pull money around and move it here and call it this and that. This is simply saying, put it in a Roth IRA, invest it, and reap the rewards from a return standpoint. So the Roth IRA is fantastic because it gets the tax out of the way. All IRAs are still good because they defer the taxes. At any point in your investment journey, you can take any of your pre-tax dollars and convert them to a Roth. So for those of you on the call that have IRAs today, whether they're invested or not, you can take the money out of that account and move it to a Roth. Now, when you do that, you've got to pay the tax. So I'll give you kind of an example of how that works. So let's say I have an IRA that I put $50,000 into, and I invested into a self-storage fund deal, and I put 50 grand into that. I can convert that either cash before I make the investment at 50 grand, or I can convert it at any time over the life of that investment based on the fair market value of that investment. The reason that I think this is critical for everyone to understand is because when we're entering in or in a market where we're going to see some compression and some price challenges on every investment, whether that be public equities, we've seen it, whether that be real estate, whether that be private syndication deals. And that's okay, right? The price doesn't matter till you sell it. But if you're invested in, let's just say, that same $50,000 storage fund, and it's got a 5 to 7 year hold, right? So they'll ride out the storm, they'll refinance when it makes sense, or whatever the strategy is. But you may see a compressed value on paper. And so if you do, just know that that compressed value, if you believe that it's just a snapshot in time, may represent a great Roth conversion opportunity. So for example, if that property, because of interest rate increases or because of a myriad of things that may not make the investment bad, but just like a stock, if you own it for 5 years, it doesn't go up for 5 straight years, right? It in a perfect world, you may see it go up and down. So to get to the kind of point here is, if you take that investment and at the end of the year, you get a valuation that says, hey, if we were to sell everything today, it'd be worth 40 grand, not 50, right? But don't worry, we're not selling it. We're going to, keep working this to maturity. That $40,000 valuation is your new fair market value. If you do a Roth conversion on that asset, you pay taxes at the 40 grand because it's what it's worth at that time, not the 50 grand that you paid for it. So I share that with you guys for a few reasons. One, even if you don't have a decline in value, you still may want to convert an asset, right? Cash is cash, it converts dollar for dollar. The second thing is that you may see opportunities if some of the values on any of these investments may drop, and I'm invested in a deal that's about 10% lower than what I put into it. But the deal's still fantastic. I think it's going to, end up being just as good as they forecasted 5 years down the road. So that's a window for me to get what we call a Roth conversion discount on a good quality asset because of the fair market value. And this is no different in the stock market. If you bought Netflix at $400, you could have converted when it dropped down to $178 per share. And you would have gotten a 50 to 60% discount on your taxes. And today it's trading over $400 again. So if you see that opportunity, given the market we're in and what, we're all, watching it closely to kind of see what it does and its impact on especially commercial real estate or real estate markets, there may be some opportunity to make some good out of some times where the valuation may not be rising in an equal manner. So I can answer some questions on that in the Q&A, but that comes up a lot. And I like to be out in front, especially as we get to the end of the year, because Roth conversion decisions are taxable year decisions. That means that if you want to convert any amount of money to a Roth and pay the taxes, it's a tax year decision, 12/31 deadline. So now's the time to start looking at your investments and start thinking about that. You cannot make a conversion January 1st for the previous year. So if you want it to be paid in this tax year, do it this year. If you want to do it January 1, that's a great strategy too, because you push the tax bill from January 1 all the way till April 15th or beyond of the following year. But if there's a benefit in your own personal return, if you have other losses or carry forwards or anything else, you should and could be very strategic about Roth conversion opportunities. And I would encourage everybody, whether it be asset-based or cash-based, or whether it be based on your own income or however you earn your money, if you've seen a slowdown in your income or you have other losses or depreciation or anything, please don't overlook the opportunity to do a Roth conversion. It's a great strategy, and it does not have to be cash to qualify. So I'll kind of leave that there and maybe open that up, under the Q&A. The last thing that I want to talk about, is I know Peggy had kind of asked in the beginning was, what does it mean to be a client? How does it work? And I'll just give you a couple of quick tips on determining who or what firm is the best custodian for you. Those decisions are always changeable, right? So you're never locked in, even though there may be a little bit of work associated with moving your account. But you have the ability to do that. It's accessible to everybody. So a few things. Number one, what's the size and scope of your custodian, right? As we enter some turbulent times, in the financial markets, does your custodian, are they well positioned to be successful for you? And not to say that they can't be, or that there's any risk with any custodians out there, but it's important to know the financial health of the custodian you're doing business with, and that's a very fair question for you to ask. The second thing is what role do you see the custodian playing, and what role do you desire? There are what we call back office custodians, right? No frills, not a whole lot. They'll service your investment, and you'll get the bare bones, and they'll charge lower fees. And that's okay if that's what you're interested in. And then you have the other end, which is, what we would consider kind of the full service custodian. Do you have a dedicated, team? Do you have dedicated service levels? Do you have, folks that understand the types of assets that you're buying? Are there educational opportunities? Do you want someone that can hold your hand? Do you want to be able to hop on a live class every week and learn new things and new opportunities? If that's important to you, then you probably want to be with someone that's going to charge you a little bit more, but be more of a true full service custodian. And you've got custodians on both ends of the spectrum. The last thing that, we always kind of look at is the service model. And that is, there's a very simple way to test the service of any organization, and that's to call a couple different times of the day and see how they answer the phone outside the sales team, right? Because we hear this a lot. Well, the sales team was super helpful, but as soon as I got in operations, no one answered their phone. And so we tell them, call, ask, how long does it take to get someone on the phone for a service related request? What's your turnaround times? Those are all measured. And if they can't give you an answer, that would be concerning, right? How long does the average person sit on hold? At NewView for the last quarter, 1 minute and 26 seconds. The average call into our building in any department sat on hold for 1 minute and 26 seconds. Turnaround time. For the last quarter, our turnaround time in true hours was about 31 hours. So just over a day to process all requests lumped into one. So some were a little faster, some were a little slower, but our average turnaround time is just a shade over a day in terms of turnaround time, which is in the industry incredibly quick and incredibly fast. Typically, most firms are doing, their processing is usually 2 to 4, 3 to 5 business days. We're for last quarter, like I said, just over a day. And so those are the types of things, not to say that we're perfect and that we get it right every time, but those are the things that you want to be thinking about if you're looking at a custodial choice. And if you're looking for the lowest cost provider and you're looking for the bare bones service, there are providers out there that are good, and they do exactly that. But if you are looking for a little bit more, we are not the highest. We're not the most full service. We consider ourselves a good quality full service custodian at a very fair price. We're right down the middle in terms of what we charge. Last thing that's important, I think, is that our team we have a syndication team and a fund team. And so I know a lot of the investments that you guys are evaluating and investing in are all passive syndication fund type deals. And we have a dedicated team with dedicated pricing to that model. So that's something that I think you guys, if you're not getting that level of experience from the groups you're working with today, I'd encourage you to at least talk to our team about that as well. So I will pause there. I think we've hit kind of the end of, I think I've droned on enough, and we've hit the time limit in terms of the first part. And let's have some fun with Q&A. So Peggy, we'll kind of pause there, and yeah, let's open up the floor.
Okay, well, Jana's got her hand up, and as always, I have several questions. So, Jana, go.
Thank you, and thank you, Jason. I want to go back a little bit. I think you covered it, but I'm not sure if it was implied. But I want to ask straight out. So, if I take my IRA and I move some of it to a self-directed IRA, and then I decide I want to convert that to Roth, do I have to sell the asset to convert it, or can I convert it mid-investment?
Yeah, great question. You can convert. So when you do a Roth conversion, that means that you take money from a pre-tax IRA and move it to a Roth, and you pay the tax. That's kind of the general premise of a conversion. You can do that in cash, which is dollar for dollar, Or you can do it what's called in kind, which is where you convert an asset and you do it at the fair market value at the time of conversion. And that's, where I kind of highlighted earlier, there may be some strategic reason to do that. So if you bought an investment for 50 grand, let's just say last year, and you wanted to convert it today, you would not convert it at the purchase price. You would convert it at its current fair market value. So if it was worth 60, you'd pay tax on 60. If it was worth 40, you'd pay tax on 40. So it's not a matter of whether it goes up or goes down. It's a matter of what's the value of that asset at that snapshot in time.
Okay, and do I have to convert the whole thing, or can I convert part of it?
Yeah, you can do partial conversions. So you can convert little by little. In fact, this is a great strategy. I call this the April 15th tax strategy, right? Which is, what does your tax bill look like, and what are you willing to pay tax on? Now, you've got a little bit of an awkward dance because you've got to do the conversion by 12/31. But if you have a picture of what your taxes look like and you've got opportunity to convert a small amount before jumping to the next bracket, you can. If you have an asset, you may be able to convert it bit by bit. It depends on the asset. So for example, if you have a $50,000 investment, going back to my storage fund example, the issuer of that investment may not let you convert part of it because it would split it technically into two shareholders, and that may cause them some issues. As far as IRS permissibility, you can do it, but you would want to confirm with the issuer if they were okay with that. If they were, let's say you had an investment that you made for 50 and was worth 40, but you only wanted to convert half. You could convert half, and now $20,000 or 50% of that unit would be held in your Roth, and 20,000 or 50% of that unit would be held in your traditional.
Okay, so NewView does in kind. Do all self-directed custodians do in kind?
No, some are very difficult to do it. They're going to require way too much. We require something from the issuer, so you can't just say it's only worth 20. We appreciate your honesty, but we can't in good faith say that that's the fair market value. But if the issuer provides us just a written letter that says the value of each unit is worth 40 grand, 20 grand, 10 grand, 50 grand, 1,000, whatever the number is, we'll take that and we'll adjust the value accordingly, and we'll do the conversion.
Yeah, what I suggest is that if you were going to be able to split it, let's say it was 50 and you're going to do 25, in December of this year, you do half, and then in January, you do the other half, so that it's really gets split fast, but you're into two IRS tax years.
Yes, and then thank you, Peggy. And then is there a limit on the end? Let's say I have an asset it's 18 months. I buy it now, which means it's going to exit in 2025. Can I convert part in 2024 and the other part in 2025? And it's still at value, or is it a tax year where that valuation is done?
So the answer is yes to all of the above. You can do it. You can split it over tax years. What it really boils down to is the length of the valuation. I won't speak to the time frame because I just don't know it in terms of our compliance. But for example, if you got a value as of December 1st, and you wanted to convert half December 31st and half January 1st, we would do that because that's a recent valuation. These assets don't move a lot over a 60-day period. If you got a valuation December 31st and you did a conversion December 31st, and then you wanted to convert October 1st of the following year, we probably would request a new valuation because the length of time has gotten long. Peggy just nailed what I think is the greatest strategy of all, and that is you can literally convert over 2 days, but split the tax bill over 2 years. So you can take a $50,000 investment, convert it 12/31 50% and January 1 50%, and you can spread your tax risk over 2 years, yet do the full conversion.
Yeah, so Peggy's helping me with some of these strategies, right, that I'm trying to deploy. Great. But let's say I convert December 31st, January 1st, the investment cashes in March 15th. My taxes aren't due till April 15th. all of that gain is going to be tax-free because it was a Roth at cash out, and then I can use the cash out to pay all of the taxes.
All right, so let me split that question, and I'll try not to get too technical on the call. So if anyone feels like I'm getting too technical, please tell me. I do this every day. So when you do a Roth conversion, the earlier in the life cycle of the asset, the better, because what you're doing is you're basically buying the profit tax-free. Because if I convert a $50,000 asset at $50,000, I'm only getting the earnings tax-free. So when we talk about Roths, I always like to make sure everyone kind of thinks of it as you're buying profit. The more profit you have, the more you can pay in a Roth conversion. So if you convert, in January and it pays off in March, if you use the fair market value from January, there may not be much growth in March, between January and March. So that may be a little bit of a defeating purpose. But to use your example, yes, you could. The IRS does not care when you do your conversion in the life cycle of an asset. It does not matter to them. But from the day you convert forward, any growth is tax-free. So if you converted January at 60 grand and it sold for 80 grand in March, then the 20 grand delta is what's tax-free to you, back to your account. As far as paying the taxes from the profits, you have to be very careful doing that unless you understand the implications. Because if you think about a Roth conversion, when you make a Roth conversion, who owes the tax bill?
I do.
You do. When there's profit from the investment in the IRA, who earns the profit?
The IRA.
The IRA. So think about that. You owe the tax bill, the IRA has the money. If you want to pay your tax bill from your IRA, what do you have to do? Take an IRA withdrawal. And so now you're going to pay tax and penalty potentially to withdraw it just to pay the taxes. So there may be some scenarios where that does work, but typically my recommendation, to folks is to be prepared to pay the tax bill outside the IRA. And I'll tell you why. I know it's not easy to do, right? So there's a financial issue with it, but you're better off, scraping your couch cushion for some pennies and the change in your car to pay it. Because if I convert $50,000 of a traditional IRA, I don't actually have $50,000. How much I have in my IRA is $50,000 less taxes because I'm going to owe the taxes eventually. If I do a conversion and it's now in a Roth, I actually have 50 grand in my IRA because I don't owe any taxes. So you're basically making an added contribution to your IRA, right, by paying it outside the account. Because now I truly have 50 grand as opposed to 50 grand less taxes. So even if it requires you to save a little and maybe delay a conversion a year, the only time I ever see it make sense, to pay out of the account is if there's a big profit expected and it's the only way to do it, and you're giving up some of the good for the great. But if you're talking about a good investment generating 12 to 18%, depending on your age and penalty and potential tax, it's probably not worth doing a Roth conversion and then paying it out of the account.
Here, let me throw something else in there that's important. If you're doing a conversion like that, you might have to pay estimated taxes. So that means you convert that now in January, you have to pay that estimated tax or whatever the quarter is. So you're paying it ahead of time anyway, because if you don't, the IRS will penalize you for not having disclosed this, and that's a penalty. So that's another reason why you need your tax advisor. You've got to talk to your tax advisor about everything like that.
That's a really good point, Peggy.
Okay, thanks. So that helps with that one. My next question is timing. How long does it take for the initial setup? Talk about the initial setup, how the pricing's done. If I want a self-directed IRA and a self-directed Roth, right? Is that 2 accounts, 2 fees? How long does it take to actually get that so I can make an investment?
Yeah, each account bears its own fees. There's very little benefit that we have to service the same account under the same account holder. We have a $50 account opening fee that we combine. So if you open a couple of accounts, you only pay it once, so there's a little bit of cost savings, but as far as annual fees, they are unique to each account. As far as timing, we can have an account open in a day. The longest pole in the tent is getting the money moved from where it sits today into the account at NewView. We are not a lot of custodians participate in ACAT transfers. We're one of the handful that do. So that expedites the money as long as you have it at an ACAT eligible firm. So what that means is that in a normal transfer, I have to mail a form to Schwab. Schwab has to receive a paper form, process it, mail me money. That can take, in the best world, a week to 2 weeks, sometimes 3 to 4. With an ACAT transfer, I can receive a transfer form today. I can go into the ACAT system and digitally request the transfer from Schwab. And usually within 24 to 48 hours, the money's in our system via the ACAT platform. So we're not a lot of custodians use ACAT because it's you have to have brokerage capabilities set up and incorporated, which we do. If we can move it, as long as it's ACAT eligible, but usually, my guidance to people is it's usually 5 to 10 days total time for us to get an account set up. The only thing that will slow it down is if you don't liquidate securities, because ACAT is a cash-based, for us, we use it as a cash-based transfer. So if you request 50 grand, but you only got 30 grand sitting in cash and the rest is in stock, it slows the process down. And then or if you're using a non-ACAT eligible firm, or there's issues on the ACAT side, outstanding fees or things that keep them from transferring it. But if you have 50 grand in cash and you give us a Schwab request, we'll probably have money on the third day.
Excellent. Thank you.
Yeah. Tina, did you have a question?
I was going to ask, if you were coming from cash account, did you have to have 2 accounts? Do you have to open an IRA account first before you get to the Roth, or can you go directly to the Roth?
I'll repeat back what I think the question is, Tina. I want to make sure I get the context right. So if you want to open an account with NewView and you want it to be a Roth, is ultimately your end goal, you've got 2 ways to get there. Either convert it at where it's sitting today. So we'll use Schwab as an example. If it's at Schwab, you can convert it at Schwab and then move it Roth to Roth, or you can move it traditional to traditional and then convert it to Roth. So you would open a second account with us. There are ways to move the money from a traditional at Schwab to a Roth with us. The only problem that we run into is that when you do an IRA to IRA transfer, it's not a reportable transfer. So the IRS doesn't get the Roth conversion details. So that would be something that, as long as they can handle it, we can accept it. So we have done traditional to Roth transfers. We call it a conversion transfer. We can do it, but we'd want to know who your custodian is, and we want to make sure that they'll label it correctly. Otherwise, it doesn't get reported correctly to the IRS.
Gotcha. Thank you.
Yeah, so hopefully that got the context of your question. It's really not an IRS issue. They allow it. It's a reporting issue. So we've seen clients do it, and then there's no reporting, and then they're kind of scrambling to figure out how they pay their taxes when there's no reporting to the IRS on it, and it gets a little bit. And then you got to go back to a custodian you closed an account with, like Schwab, and try to get them to do something for you. And so it sounds good in theory, but it may be more work than just doing the conversion and moving it Roth to Roth, or just move it traditional to traditional. If you open an account with us solely for the purpose of conversion, there's no fees.
Okay. Thank you.
So what savings, you're limited on what you can put in, right? If it's a savings, which of course is after tax dollars, you can't just inherit. I'm talking inherited. So if I inherited my grandmother's savings account and she didn't have it in any kind of a IRA account, would I have to only allow to put my 7,000 or whatever in?
Yeah, I mean, we can work with, people setting up accounts and starting them. The challenge you've got is that there's a lot of limitations on how much of your personal money, whether it's inherited or your money, you can add to an IRA in any 1 year. So yes, anything that's outside of an IRA today, in order to put it in an IRA with me or Schwab or any other firm, you have IRS guidelines. There are some plans that have higher contribution limits, so there may be some opportunity to, enter into a plan like a solo 401k that has a higher contribution limit if you're eligible. But each of those has an eligibility requirement, which, we can walk you through. Most of our accounts, especially that are investing passively, generally are coming to us with, kind of some retirement money already saved up, whether that be an existing IRA or an old 401k.
Yeah. So if you inherited the money and you put it in a 401k, then you have to pay taxes on it again to roll it into a Roth. So it just created a taxable event.
Well, and there, yes and no. When you inherit money, you may have to pay inheritance tax, and that is not income tax. That's inheritance tax. Once that money's in your name, so let's just use you, Peggy, if that's okay, as an example. You've got $50,000 that you inherited, regardless of who it's from. If you convert that to a Roth, put it into an account and convert it to a Roth, assuming you're eligible and you meet the requirements, while you are paying the tax on 50 grand, and that does feel like you're paying double tax, what you're really doing is you're not paying tax on anything in arrears. You're buying all the future gains on that money today. So, it's the only time the IRS lets us prepay taxes. Now, I will tell you, I am definitely a staunch advocate of Roths, almost to a fault. I would almost make a case. I don't care what tax bracket you are. If you're a moderately decent investor, you should be in a Roth. Bite the bullet, pay the tax, quit counting pennies, and take advantage. And I say that for a few different reasons. One, because you're basically putting more money in your retirement account, and you'll never be upset to have more money. So even if you looked and said, oh man, I paid it at 28% tax and now I'm only in 24% tax, I lost 4%. The reality is, no, you didn't, because you may have turned that money 2, 3, 4 times, where if you kept it out of an IRA and you bought and sold and bought and sold and bought and sold, each of those represent taxable events. So very rarely, unless you're only going to turn it once or twice, are you going to lose that game. The second thing is that it's such an amazing opportunity. I mean, here's an example. If January 1st, and I'll ask this to the group as a whole, if I gave you a number, January 1st, and I said, okay, Tina, you can prepay your taxes for 2024, but you got to pay me 20 grand today. Well, you're going to go 20 grand. All right. How much do I think I can make? How much? Yeah, hell yeah, I'll pay you 20 grand today. You would jump all over the prepayment if you felt like it was a good deal. That's exactly what a Roth is. It's the only time the IRS invites us to prepay on our terms, because normally at the end of the year, right, I got to pay on their terms. How much money did I make? What are my sources of income? And then I scramble under their terms to try to get rid of my tax liability, right? What are my write-offs? What can I do, et cetera. And a Roth IRA is like the greatest tool, because I'm basically saying, I'm going to write a check under a number I'm comfortable with, and I'm never going to pay you a penny of tax on those dollars ever again. If you really think about it under that manner, today's 2023, if you wrote that check today, 24 tax-free, 25 tax-free, 26, you don't have to make this every year and play this game. So does the number and the math always work out? I don't know. But I think if you pay good mind to your money and you invest it in a moderately sufficient way, you're going to end up happy you did a Roth for the following reasons. Number one, you paid the tax bill today while you had income, instead of paying it during retirement where you may need every penny, right? You're paying it today at rates that are likely lower based on everything that we've seen over the history of time than we're going to see 10 years, 20 years, 30 years, depending on how far out you are from retirement. And then lastly, when you get to retirement, you'll have the confidence that you know how much money you have. So, if I pay an extra $1,000 this year in tax because I put my money into a Roth instead of a traditional, I won't miss the $1,000. In fact, I won't blow it on something stupid. I at least blew it on a tax bill, and 20, 30 years from now, when I withdraw that money, I'm fairly certain I'll make up that $1,000 along the way. So I love the Roth. I think everybody should be tripping over themselves to get into the Roth. I think everybody should be setting a financial plan, even more so than their investment strategy. Is that it should be equal parts your investment strategy and equal parts your tax strategy. Because if I go back to my example, the difference between having $1 million versus having $78,000 was not my investments. It was the tax. So if I can do both of those things, I mean, that's just as good as it gets.
Thank you. Paul.
Thanks, Peggy. Hey, Jason, thanks for your presentation. Had a question because I think some of us on this call are getting close to retirement. And it was my understanding if we do a Roth conversion, that those funds aren't available to us for 5 years after the conversion is made, unless we pay a penalty. Is that right? I just want to confirm my understanding there. And then I got a second question after that.
Yeah, so thank you, Paul, for the question. Yes, there is a 5-year incubation period on Roths as a whole. So the reason I kind of say it that way is you do not have to wait 5 years on each dollar based on its conversion. You have to wait 5 years from the oldest dollar you put into a Roth. So if you've ever started a Roth or done a Roth conversion, even if it was $1, your 5-year clock is already running. But let's assume you've never done a Roth and you start it today. Yes, you've got a 5-year clock. While that 5-year clock feels like a lockup period, I don't think it's worth converting if you can't get at least 5 years of profits tax-free, because you're buying the profit and you want some time. So, I use my couch cushion example. Like, I have different buckets of money, and when you reach retirement, chances are you're going to have different buckets, whether that's Social Security, whether that's personal accounts, whether that's business investments or interests that generate passive income. And then you have all your retirement buckets, pre-tax, post-tax, whatever they may be. The bucket that I am touching last, and when I say last, I mean after every single penny has been, picked up for my couch cushions and my vehicle, then I'm touching my Roth. So if you've got other forms of money and other buckets that you've put them in, before you look at the Roth as being, your retirement money, that's the last money you should touch, because it's the most efficient money you have. It's growing tax-free. Every other dollar you have, while maybe working for you, will always be less efficient than a tax-free dollar. So if you have the ability to make it through the next 5 to 10 years, first 5 to 10 years of retirement off of your personal savings and off of all these other things, then I wouldn't think twice about a Roth conversion, because you can push it out to the last dollars, and based on your financial plan and the way you've kind of pro forma retirement, you may not even need that money until your 10th or 15th year of retirement. So a little bit of a technical kind of strategy level, thought, but yes to the 5 years, but don't be scared to convert unless you've got at least 5 to 10 years to really grow that money tax-free, because that's what you're buying.
You should be able to do that in 5 to 6 years, double your money.
Mm-hmm.
So,
In real estate anyway. I won't speak for stock ever. And he has another question.
and well, maybe a couple more now. Sorry.
Okay.
So just for clarification, so if I've had Roth accounts that have been open for 10 years, and now I have an IRA that I'm now going to be converting to a Roth, in 2020, end of 2023, the fact that I opened my first Roth in 2013 helps me out with respect to that conversion. I can touch those dollars that I'm converting now. Is that right?
That's correct. The 5-year clock is not an individual dollar incubation period, and it's a little silly. But here's what they're trying to do. What they were trying to prevent is people from using the Roth as a way to get money out of their IRAs early. So as long as you're over 59 and a half and you've met the 5-year clock on a Roth dollar, then you can withdraw all of your Roth money completely tax-free. If you're under 59 and a half, you can always take out principal, which is your Roth principal, tax-free but you'll pay a 10% penalty if it's inside the 5 years. And this is a little loophole in Roths. And if it's okay, Peggy, if I'm okay to kind of hit on this, one of the things that's great about a Roth is a Roth's kind of like a savings account. You can put money into a Roth, and even though you're under 59 and a half, you can take your principal out tax and penalty free. You only pay penalty and tax on the gains. So there's some pretty cool strategies. The reason they do the 5-year clock on conversions is only if you're under 59 and a half, so that you can't convert and withdrawal immediately. But if you're 60 years old and you convert your Roth, your traditional, to a Roth today, you can withdraw it all tomorrow, tax free, because you're over 59 and a half.
I got
Awesome.
that. Anything else, Paul?
Yeah, one of the other things that I thought was really cool in doing some research regarding Roths relative to traditional IRAs is that there doesn't appear to be a required minimum distribution on the Roth, whereas there are required minimum distributions on the traditionals. I
Yep.
just wanted to confirm that my understanding is correct there.
Correct. Yep. They want their money. They want their taxes. That's why that required that's why you have an RMD on your traditional.
Okay, thank you very much.
Ask me how I know.
Thanks so much. All my questions have been answered. Thank you.
Absolutely.
And I don't need that money, but I have to take it because Mr. Sam wants his money.
Yeah, RMDs are, thankfully the Secure Act and Secure 2.0 have pushed them back, which is nice. But yes, it's the unfortunate part of the way that IRAs work is that, and that's another feather in the cap for the Roth.
Yep. Jana has some more questions, and when she's done,
I
there's
do, and
yes.
and unfortunately, pushing your RMDs back just puts you in a higher tax bracket. It's not a good thing. So another question: are self-directed IRAs reversible?
You'll have to give me a little more context. Sorry.
So if let's say I take my IRA, I move some money into self-directed IRA, it does very well, the stock market crashes, and I think, hey, I want to move some money back into the stock market. Can I convert back to a traditional?
Yeah. It really, and it's something, and we kind of talk, especially those of us that have been in the industry a long time. We've really created the problem ourselves. Is we've kind of used the moniker of a self-directed IRA as kind of to define it. And the reality is a self-directed IRA is no such thing defined by the IRS. It's a marketing term. If you have a Roth, you have a Roth with me, or you have a Roth with Schwab. If you have a traditional, you have a traditional with Schwab or a traditional with me. Self-direction just means that you're at a custodial firm that gives you more choice. So as far as choice goes, yes, they're completely portable at all times. So you can move an IRA from Schwab to NewView, from NewView to Schwab, from Schwab to NewView, and NewView to Schwab every year if you want, or every other week if you want. So there's no portability issues at all. You reserve the right. All you're really doing is doing two things. Number one, you're changing your custodian, and you reserve the right to do that at any time. And then secondly, you're simply changing your investment choice.
Okay. And we can take this one as a separate subject because it might be a big can that we open.
You have 5 minutes left.
All right. Well, it is strategy for those that have sizable traditional IRAs, non-Roths. The issue with getting them to the Roth is paying the taxes, coming up with the cash to pay the taxes. Any strategies, ideas other than the ones we've talked on larger ones? Yeah.
Couple at a high level, and I'll try to keep it quick. We can add more detail, but the first strategy is to offset your taxes in other ways. And so I've seen clients that have made investments with their personal money into heavily depreciable assets, stuff that has bonus depreciation, which is now not as good as it was, but still good. I've seen people invest into asset classes that have big depreciations. Oil and gas would be an example. And so, technically, you're not really supposed to buy an investment for its tax purposes. However, if I can put $100,000 into an investment that I think is a good investment that happens to kick back an $80,000 tax deduction for my taxes, I may be willing to do a Roth conversion of 80 grand as an offset. And if you kind of do the math on that, right? I mean, depending on what tax bracket you're in, that could be a 35% discount on your Roth conversion. The second thing is that I always encourage, pick a number that you're comfortable paying the tax on. This is just a Jason Debono personal, philosophy. Pick a number that you're willing to pay tax on. It's your number, not mine. If that number is 20, 28, 30, 35, pick the number. Tell your accountant. And if you're not using an accountant, get an accountant. If you're trying to figure this stuff out on your own, regardless of your experience with an accountant, they're fantastic if they're good. And if they're great, they're exceptional. But pick a number. So if your number is 28%, tell your accountant, hey, by 12/31, I need you to do an estimate of my taxes, and I want a number of how much I can convert that I will not pay more than 28% tax on. And your accountant may say, okay, Jenna, that number is 26 grand. There's your number of conversion for the year. And your strategy is, I'm willing to convert every penny I can up to 28%. And if that number is 80 this year, convert 80. If it's 40, convert 40. And so there's some strategies where you can kind of set a dial, because what happens is people don't like doing conversions. And I'm not painting anyone with this brushstroke, but I'll paint everybody with a similar brushstroke, fair or unfairly. We all get super cheap when it comes to our taxes. I don't know what it is. We all have this philosophy when it comes to taxes. It's like a game. The less we pay, the better. And we train our accountants to not make the best decision for us. We train our accountants to save us as much money as possible. And so most accountants, the reason people don't really love them is because they only focus on one day. They're not planners, right? So they're looking, saying, okay, I saved you 12 grand and you are like high-fiving and, oh, I got a tax return, or whatever your commentary is. And the reality is you actually just pissed away 30 grand or 50 grand over the next 10 years because you missed out on opportunities in the long term. So I think it's really critical for people to think about Roth conversions as a true growth strategy, not a tax bill. And so many people get hung up on the tax bill that this goes back to that. They let the tax tail wag the dog, and they think, I'm not converting. I don't want to pay $45,000 of taxes. And my viewpoint is, I'll pay $1 million in taxes if I make $1.1 million, because I come out $1 ahead. But some people would rather, pay more in taxes or less in taxes because they think they're winning a game. So, one question I ask at the very beginning of a lot of my full educational classes is, how many people in here like paying taxes? And nobody raises their hand. And then I raise both hands. Like, I hope I have a $2 million tax bill. Last time I checked, the tax rate, is still sitting under 40%. So, let's see, I can make 10 million and pay 4 million in taxes. Yeah, I'm in. No problem. Hell, pay me 20 million. Pay me 100 million. I'll pay 40% tax. So, the end of this kind of discussion is all about, we don't want to pay 40%, but we want to make money. And if we want to make money, we got to be willing to pay taxes. And this is where kind of understanding the strategies and the games and figuring out how the wealthy do it is the game that we're all playing. And it's why I come back to IRAs is no better tax tool that's readily available than an IRA.
Thank you.
Use it for what it's worth and strategize, but don't be scared to pay tax. Just try to pay as little as you can, but don't think of taxes as a bill. Think of taxes as an investment. And if I can invest 50 grand today that saves me 200 grand tomorrow, that's no different than buying an investment for 50 grand today that pays me 200 grand tomorrow. It's just money we don't see, so we don't value it the same, but it works the exact same way.
That's brilliant. We should talk to our accountants about that. Paul also had a question now that we're at the top of the hour. Go, Paul. What's your question?
I think I'm done. Thanks so much, Peggy.
Okay. Jonna, you have another question?
I'm good. Thank you very much.
Okay. So one of the things you didn't bring up, and we are at the top of the hour, so if you could just take a couple seconds, you do have an educational program people could come in and watch, or do they have to be members to come to the education?
Nope. I would say 99% of our education is free. You can view it all on our website, our YouTube page. We talk a lot about taxes. We talk a lot about how IRAs work. We're not investors or investment, advisors or managers. So, we tend to shy away from that stuff. But if you're interested in Roth conversions, we've got multiple videos on Roth conversions and different strategies. We also do a live class every Tuesday at noon Eastern time, depending on your time zone. So it's noon Eastern time. Those are live, similar to what we did today. Sometimes we have guest speakers. Sometimes, it's just a strategy that we're educating on ourselves. But we run those every Tuesday. You can ask questions and participate, or you can watch them after the fact, and you just can't ask questions because they're in a recorded version.
Okay. Thank you very much. Thank you very much for coming. I have to tell you, this is very enlightening. You are actually the first person to really talk about how important the Roth is. So thank you so very much, Jason, for being here. We'd love to
You're
have you come
welcome.
back again.
I look forward to it. And thanks, everybody. And yeah, if you have further questions at all, you can just, so everyone has a quick contact info for me. You can email me at Jason, which is just first name, at newviewtrust.com with a U. So NUVIEW trust.com.
All right. Thank you. And we'll send that out to everyone.
Awesome.
Thank you, everyone. Well, thank you for attending the Nest Egg Builder Show. We'll see you next week. Same time, same station.